Listen to me very carefully. While you were scrolling through your phone last week, something unprecedented happened in the global financial system. Central banks quietly purchased more gold in a single month than they did in the entire year of 2010. We're not talking about a trend. We're talking about panic buying at the institutional level. And here's what nobody's telling you. The smart money already knows what's coming in 2026, and they're positioning for it right now, while you're still trying to figure out if you should even care about precious metals. I'm the Asian guy, and I spend my days analyzing markets, gold, silver, and the macro trends that actually move billions of dollars. Before I start, please like the video and subscribe. I've just started this new channel, and the upcoming content is going to be absolutely insane. Now, what I'm seeing right now in the gold and silver markets is something I haven't seen in my entire career. This video is about 2026 and why the behavior of these metals is changing in ways that should concern every single person watching this. But here's the thing. You need to stay with me until the end because the final piece of this puzzle completely changes how you should be thinking about everything I'm about to tell you. Let's start with what's actually happening right now. Gold and silver are not behaving normally anymore, and I don't mean that in some vague conspiracy theory way. I mean the mathematical patterns, the institutional flows, the physical demand. All of it is diverging from historical norms in ways that are measurable and, frankly, deeply unsettling. Some of these signals look incredibly strong, the kind of signals that precede massive moves higher. But others, and this is what keeps me up at night, look very dangerous, the kind of dangerous that wipes out portfolios. Here's what most analysts won't tell you. 2026 is shaping up to be a decision year, not a trend year. What does that mean? It means we're not necessarily going straight up or straight down. We're entering a phase where positioning matters more than prediction. Where being right about the direction but wrong about the timing will destroy you just as badly as being completely wrong. And while all of this is happening, big money, the sovereign wealth funds, the family offices managing billions, the central banks themselves, they're positioning quietly. No press releases, no CNBC interviews, just steady, relentless accumulation. Meanwhile, retail investors, regular people like you and me, we're still confused. Still trying to figure out if this is even real or just another false alarm like we've seen a dozen times before. But here's the real risk, and this is critical. The real risk is not missing the upside. That's what everyone fears. Missing the rally. No, the real risk is being on the wrong side when the mood changes, when the narrative flips, when what everyone believed was true on Monday becomes laughably naive by Friday. That's where fortunes are lost. So let me take you through this properly. We're going to look at the bullish case first, because that's the story most people are hearing right now, the hopeful story, the one that makes sense when you read it. Then we're going to examine what's actually broken in that narrative, the cracks nobody wants to talk about. And finally, I'm going to show you what 2026 might actually look like, not based on hope or fear, but based on how these markets actually function when everyone thinks they have it figured out. Let's talk about why gold and silver are getting so much attention again. Something fundamental has shifted in how the world thinks about money and stability, not just in fringe communities or among gold bugs who've been predicting collapse for 40 years. I'm talking about institutional shifts, real capital allocators who manage pension funds and endowments. These people are looking at the global financial system, and they're seeing something that genuinely concerns them, a loss of confidence in long-term stability. Think about what's happened just in the last 4 years. Multiple regional bank failures, unprecedented monetary interventions, debt levels that would have been considered catastrophic a generation ago now being treated as normal, currency volatility that used to happen in emerging markets now happening between major reserve currencies. When that kind of instability becomes the baseline, capital starts looking for alternatives. And historically, when capital gets genuinely worried about systemic stability, it rotates into hard assets, specifically metals. Gold and silver start being seen not as investments, but as stores of value during periods of uncertainty. This distinction matters enormously. An investment implies you're trying to grow wealth. A store of value means you're trying to preserve it. And right now, preservation is becoming a higher priority than growth for a significant amount of global wealth. But here's where it gets really interesting. Look at what central banks are doing. Central bank gold purchases hit record levels in 2022, then stayed elevated through 2023 and 2024. We're not talking about small players. China, Russia, Poland, Singapore, Turkey, India. These are massive economies systematically increasing their gold reserves. Why? Because there's less trust in the fiat system than at any point in modern history. When central banks themselves are hedging against the currencies they issue, that should tell you something profound about what they see coming. And this isn't short-term trading. Central banks don't buy gold because they think it's going up 20% next quarter. They buy gold because they're thinking in decades. They're hedging against scenarios most people can't even imagine. Political instability, currency resets, systemic failures. This is long-term hedging mindset, not speculation. Now let's talk about silver specifically, because silver has a different story entirely. Silver has this dual nature that makes it fascinating and dangerous. It's a monetary metal like gold, but it's also an industrial metal. And the industrial demand narrative for silver right now is compelling in ways it hasn't been in decades. Solar panels, electric vehicles, 5G infrastructure, advanced electronics. All of these technologies require silver in quantities that are not optional. You cannot substitute it in most applications. The physical properties of silver make it irreplaceable for certain industrial processes. And here's the kicker. Supply growth for silver is limited. Most silver comes as a byproduct of other mining operations. Copper mines, lead, and zinc mines. You don't just open a silver mine when prices go up like you might with other commodities. The lag time is years, sometimes a decade. So if demand genuinely accelerates and supply cannot respond quickly, you get the setup for a supply squeeze. But there's something else about silver that everyone who's studied it knows. Silver historically lags gold. It underperforms. It frustrates people. And then, seemingly out of nowhere, it moves violently. In 2010 and 2011, silver went from $15 to nearly $50 in less than a year. That's more than a triple. And it happened after years of silver being boring and disappointing. The pattern suggests that silver doesn't move until it absolutely has to. And when it does, the velocity is shocking. Look at the current market positioning signals and you'll see something interesting developing. Futures and derivatives markets are showing increasing interest in precious metals, not retail interest. That's actually still relatively subdued. I'm talking about institutional hedging, large positions being built quietly. Physical demand for both gold and silver is rising, but it's rising quietly. The big buyers aren't announcing what they're doing. They're just steadily accumulating. And this matters because it means retail participation still isn't extreme yet. When retail gets euphoric, when your neighbor starts texting you about silver stocks, that's usually the top. We're not there yet, not even close. So let me summarize the bullish case clearly, because this is the story that most analysts are focused on right now. Many serious, credible people believe that gold and silver are setting up for a powerful move higher. The fundamental conditions, the institutional behavior, the physical demand patterns, all of it suggests that if these conditions stay supportive, 2026 could surprise dramatically to the upside, gold potentially testing $6,000 or higher, silver potentially breaking through $100, $140, maybe $145 last. This is not a fringe view. This is what a significant portion of the market is pricing in, or at least preparing for. And honestly, when you lay it all out like that, it sounds pretty convincing, doesn't it? The logic holds together. The evidence supports it. You can see why smart people believe this story, but here's the thing. Markets rarely reward everyone at the same time. Let me ask you something. When was the last time you saw a trade that everyone agreed on actually work out exactly as expected? When was the last time the obvious setup, the one with the clear fundamentals and the institutional support and the logical narrative, just played out smoothly for everyone involved? It doesn't happen, because markets don't work that way. Markets work by finding the maximum number of people positioned the same direction and then doing something that destroys them. This is where we need to talk about crowd psychology and why optimism itself can become dangerous. When narratives become one-sided, when everyone's focused on the same story, when the reasons to be bullish are recited like a catechism that everyone's memorized, that's precisely when you need to start asking uncomfortable questions. Not because the narrative is necessarily wrong, but because when everyone believes the same thing, the market doesn't need to reward that belief. It needs to shake people out. It needs to create doubt. It needs to test conviction. And there's a massive difference between smart money and loud money. Smart money accumulates quietly and doesn't need to convince anyone. Loud money needs validation. It needs other people to agree. It needs the narrative to spread. And once the loud money gets involved, once the story becomes mainstream, that's often the signal that the easy part is over. Look at how gold and silver have been behaving recently, and you'll see some price behavior red flags that should concern you. The speed of recent moves has been unusual, sharp rallies followed by equally sharp pullbacks. That's not what healthy, sustainable trends look like. Healthy trends grind higher with consolidations. They frustrate people. They take time. But what we've been seeing is volatility, violent swings, overreactions to news events that shouldn't matter that much. When gold moves $50 on a single employment report, or silver crashes 5% because of a Fed comment that wasn't even about metals, that tells you something. It tells you the market is nervous. It tells you positions are crowded. It tells you leverage is involved. And here's the uncomfortable truth. This is exactly where strong trends start becoming unstable. Now we need to talk about the bearish case, the fear case, the scenario that nobody wants to hear, but everyone needs to understand. Let's start with silver's dark side, because silver has a history that should terrify anyone who doesn't respect it. Silver is historically far more volatile than gold. It's not even close. Gold might move 2% in a day during times of stress. Silver can move 10%, and that cuts both ways. Yes, silver can explode higher faster than gold, but it can also collapse faster. In past rallies, the big ones that everyone remembers fondly, they didn't end with gentle corrections. They ended with brutal, portfolio-destroying crashes. After silver hit $50 in 2011, it didn't gently decline. It crashed. Within weeks, it was back to 35. Within months, it was below 30. Within a couple years, it was trading in the teens. That's a 70% decline from the peak, 70%. And that wasn't some anomaly. That's how silver works. When the speculative fever breaks, when the leverage unwinds, when the momentum traders bail, silver doesn't offer you a gentle exit. It offers you a catastrophic loss. 30 to 50% drops are not rare in silver cycles. They're normal. They're expected. They're part of what silver does. So when someone tells you silver is going to $100, you need to also understand that the path from 100 to 150 might include a detour down to 60s or maybe 50s. And if you're leveraged, if you're overexposed, if you're emotionally attached to the narrative, that detour destroys you even if the final destination was correct. But here's what really keeps me up at night. Gold is not always safe either. This might shock some people, but gold can have long periods of complete stagnation. Look at the decade from 2013 to 2019. Gold went essentially nowhere. It oscillated between 1100 and 1400 for 6 years. If you bought at the wrong time in that range, you sat through years of frustration, watching your capital do nothing, while everything else, stocks, real estate, even bonds, generated returns. That's the opportunity cost problem with gold. It doesn't pay dividends. It doesn't generate cash flow. It just sits there. And if it's not appreciating, you're losing to inflation in real terms. And here's the thing that gold bugs never want to admit. Gold can fall even during uncertainty. It happened in 2008. Everyone remembers gold going up during the financial crisis, but they forget that in the acute phase in September and October 2008, when everything was imploding, gold fell too. Why? Because in a real liquidity crisis, everything gets sold. Margin calls don't care about your narrative. Redemptions don't care about safe haven theory. And when people need cash, they sell what they can, not what they want to. And gold is liquid, so it gets sold. Which brings us to a scenario that's becoming increasingly possible, a policy and liquidity shock. Imagine this. Interest rates are still elevated by historical standards. Central banks are trying to maintain some semblance of credibility on inflation. And then something breaks, not in some predictable way, but something unexpected. A sovereign debt crisis in an unexpected country. A major financial institution failing because of exposure to something nobody was watching. A geopolitical event that freezes credit markets. Whatever it is, it triggers a sudden, violent liquidity tightening. What happens to gold and silver in that environment? Theory says they should rally as safe havens. But practice, actual market behavior when stress gets real, suggests something different. They get sold. Because people need dollars. Because margin calls are denominated in dollars. Because even if you believe in gold long term, if your fund is getting redemptions, you sell what you can sell quickly. And gold and silver are among the most liquid alternatives to cash, which means they're early in the selling queue. This has happened before, multiple times, and it can happen again. Now let me tell you about the scenario nobody likes to talk about. The one that breaks the narrative completely, gold and silver falling together. Not because the fundamentals changed, not because central banks stopped buying, not because industrial demand collapsed, but because the safe haven narrative itself temporarily breaks. Because confidence in the trade, not in the metals themselves, but in the trade, evaporates. And once that confidence breaks, you get panic selling by late entrants. The people who bought highest, the people with the weakest hands, the people who believed the story but didn't understand the risks. And here's where the most damage happens. The most damage happens when confidence breaks suddenly. When Monday's obvious trade becomes Wednesday's disaster. When the people who were certain, who were all in, who were leveraged, suddenly realized they were wrong about timing, even if they might be right about direction. That realization, that psychological break, that's what creates the violent moves that destroy portfolios. Let me slow down here, because this is important. We're talking about 2026 being a decision year. But what does that actually mean for you? What does that mean for someone trying to navigate this without getting destroyed? Let's look at the possible outcomes honestly. No hype, no fear, just probabilities. Outcome 1, gradual upside with volatility. Gold slowly grinds toward 6,000. Silver oscillates wildly but trends higher over the year. This is the scenario where patient, non-leveraged holders do okay. They experience drawdowns of 10 or 15% along the way, but if they can stomach that, they end the year ahead. This is probably the best case scenario that's actually realistic. Outcome 2, sharp spike followed by violent correction. This is the adrenaline scenario. Gold rushes to $5,000 in the first half of the year. Silver explodes to $100. Everyone's euphoric. CNBC is talking about precious metals every day. Your relatives are asking you how to buy silver coins, and then, seemingly out of nowhere, it reverses. Hard. Gold back to 3,500 within weeks, silver back to 60s. This kind of whipsaw destroys more people than a straight decline because it sucks everyone in at the top. Outcome 3, long sideways frustration phase. This is the most psychologically painful scenario. Gold and silver just chop. They go up 5%, down 4%, up 3%, down 6%, month after month. No clear direction, no vindication for either the bulls or the bears. Just endless, grinding, sideways volatility that exhausts everyone. People give up. They rotate to whatever's actually moving. And then, maybe in 2027, maybe later, the real move finally happens. But by then, most people have lost patience. Which of these is most likely? Honestly, I don't know. Nobody does. Anyone who tells you they know with certainty is either lying or delusional. But here's what I do know. Most people will make the same mistakes regardless of which outcome actually happens. They'll go in with too much exposure. They'll use leverage they don't understand. They'll get emotionally attached to a narrative and refuse to adjust when the evidence changes. And they'll completely ignore risk management because risk management is boring and narratives are exciting. Let me tell you what the smart money is actually doing right now, not what they're saying, or what they're doing. They're building positions slowly. They're keeping dry powder. They're using options to define risk instead of just buying futures or shares. They're diversifying across different ways to access the trade. Physical, mining stocks, royalty companies, derivatives. They're not all in on any single approach. And most importantly, they have exit plans. They know at what price they're wrong. They know at what point the thesis has failed. They're not married to the trade. Compare that to what retail typically does. Retail hears a compelling story. Retail goes all in. Retail checks prices every day. Retail panics at the first correction. Retail sells at the bottom out of fear. Retail buys back in at the top out of FOMO. Retail gets destroyed not by being wrong about direction, but by being unable to handle the volatility of being right. This is where people usually stop thinking clearly. This is where emotion takes over. This is where you need to be most careful. Here's the final piece. The piece that changes how you should think about all of this. Gold and silver are not inherently good or bad investments. They're not moral. They're not on your side. They're just assets that respond to supply and demand and sentiment and liquidity like everything else. The value of gold and silver is entirely dependent on what someone else will pay for them tomorrow. That's it. There's no intrinsic cash flow, no earnings, no growth, just collective belief. So when you're evaluating whether to be involved in this trade, you're not evaluating gold and silver, you're evaluating collective human psychology. You're evaluating whether other people will want these metals more in the future than they do today. You're evaluating timing and positioning and sentiment. And that's much harder than evaluating a business or a technology or a trend. Because psychology is unpredictable. Sentiment shifts in ways that fundamentals never would justify. And timing, getting the timing right, that's where most people fail, even when they're directionally correct. 2026 could absolutely reward preparation, if you're positioned correctly, if you're not over-leveraged, if you understand what you own and why you own it, if you can handle the volatility without panicking. But 2026 could just as easily punish confidence, punish certainty, punish people who were so sure they were right that they forgot to prepare for being wrong. The real edge in markets isn't predicting the future. Nobody can do that consistently. The real edge is being ready for multiple outcomes, having a plan for what you'll do if you're right, having a plan for what you'll do if you're wrong, having the emotional discipline to execute those plans when your brain is screaming at you to do something else. That's what separates people who survive these markets from people who get destroyed by them. So here's where we are. Gold and silver are behaving strangely. The setup looks both compelling and dangerous. Big money is positioning. Retail is still uncertain. 2026 is coming fast. Nobody knows for sure what's going to happen, but you now understand the full picture. You understand the bullish case and why it's compelling. You understand the bearish case and why it's terrifying. You understand that timing and positioning matter more than belief. You understand that the obvious trade is rarely the profitable one. And you understand that the most damage happens when everyone is convinced they're right. If you found this valuable, if this changed how you're thinking about precious metals, hit that like button and subscribe to the channel. I analyze markets without the hype, without the agenda, just the data and the patterns that actually matter. The shockwave is building. Whether it lifts you up or crushes you depends entirely on how you prepare for it. And preparation starts with understanding that certainty is the enemy, flexibility is the weapon, and respect for what you don't know is what keeps you alive. The game has begun. Make sure you're playing it correctly. If you like this video, make sure you like and subscribe, and I will see you in the next one.